Hi everyone, this is Ian Shepherdson. Thanks for joining me for the webinar on US inflation. It's now 3 o'clock in the UK, 10 o'clock Eastern Time US, but I can see we've still got a few people joining. So we'll just wait for a couple of minutes and then we'll get started. I want to make sure everybody who's trying to get in can get in before we start. Thanks. Hi everyone, thanks for your patience. I think everyone who's trying to get in appears to be in now, so let's get started. Thanks for taking the time to listen in and watch this webinar, which is going to be a bit different. I thought that rather than doing the kind of usual, here's my big picture of the whole economy story, I would focus instead on the inflation picture, which might seem kind of perverse given that not very much is happening to inflation right now. But what I want to do is tie in the current picture with what I think is likely to happen and how that fits into the Fed's way of thinking, specifically in terms of the way they look at future inflation risk via the labor market and how that ties in with their current policy setting. So with no further ado, let's get going. I mean, from a very big picture perspective, if we look at inflation through the lens of unit labor costs, which is kind of the way the Fed does it essentially, because labor costs are 70 to 80% of most business costs. When you look at the unit labor cost picture now on that first chart there on the screen, it's very hard to be nervous about anything. The data are very noisy. The unit labor cost numbers are extraordinarily noisy because productivity is so badly measured in the short term. But the big picture is that the trend in unit labor cost growth is currently less than 2%. It's very hard to look at that chart and think that in the next few months inflation is going to shoot above 2.5 or indeed anything like it. So I think this is really quite a comforting picture if you're sitting at the Fed with a cost push view of the world. The other way to look at it, of course, is ask what companies, what they're doing with their pricing, with their own pricing. And the message here is equally comforting, really. So this chart is the NFIB selling price number. It tends to be influenced by gasoline prices, so it'll probably drop over the next couple of months. But if you strip the gas price effect out, it tracks the core CPI or leads the core CPI actually by about a year. It's not always dead right, and the lag varies somewhat, but broadly speaking, it's a pretty good leading indicator of core CPI inflation, and it suggests that over the next year or so, 2.25% is about what would be reasonable to look for. Again, it's very hard to get alarmed about that. There's nothing worrying in those numbers at all, it's consistent with the message that we're seeing from unit labor costs. It also suggests, I suppose, that there's no great effort on the part of businesses to start widening margins or to seek wider margins, even though demand has been very strong, boosted by the tax cuts, very strong growth in Q3 and Q2, and yet despite that, no evidence of a concerted attempt yet to start boosting margins. Now, that could still happen, of course, but I think from the Fed's perspective, in the absence of any evidence that it's happening now, the focus, I think, is still likely to be on the wages numbers. And the starting point to think about the wages numbers is in the unemployment rate, which is now 3.7 and falling. So what I've done here is just projected forward the unemployment rate, assuming that the current 24-month averages for the labor force and household job growth continue. these data are extraordinarily noisy in the short term. That's why I'm using a 24-month average. Even the 12-month is all over the place. And shorter term measures of labour force growth just mean nothing. The household survey, although over time it tends to track the payroll numbers, it doesn't track the payroll numbers closely in the short term because the survey is much smaller and much less reliable. So just stepping back from the short-term noise, the fact is that the unemployment rate has been barreling downwards in more or less a straight line for several years now. And looking at the current trends, it seems quite reasonable to think that's going to continue. So a year from now, we should be looking at an unemployment rate of just over 3%. The current rate, 3.7, is the lowest since 1969. If we get down towards 3, then we're looking at rates we haven't seen for 60 years. Nobody at the Fed thinks that's sustainable. There's an argument about where the narrow is, so the current estimate of about 4.5. I think you probably find fairly broad agreement now that that might be a bit too high, but I don't think anyone thinks it's 3% or indeed anything like it. But that's where we're going. Now, of course, things might change if labour demand suddenly were to reverse, or if the rate of growth of the labour force suddenly were to increase. But I'm not really seeing a lot of evidence of that at the moment. So if we look at labour demand, first of all, from the business side of things, so this chart is the sort of a mashup of a bunch of employment indicators into a single index. And what it suggests is that labour demand has picked up markedly in recent months. It also shows that the actual payroll numbers have been running a bit below the strength of labour demand since late last year. The very latest number for October was above, but that was because of the rebound from the hurricanes. But the trend has been below, which suggests that what we've got here is unsatisfied labour demand. Businesses want to hire more people than they can find. Am I wedded to the idea that they want to hire 300, 350,000 a month? I don't know. These numbers are all very volatile, but what's pretty clear is that if labour force growth is 120, which is the 2-year moving average, then labour demand of approaching 300 or just high 200s is clearly swamping any plausible rate of growth of the labour force. And that means that the unemployment rate not only is going to keep falling, but it might fall faster than that previous chart suggested. Can't rule out the idea that unemployment will hit 3% sometime in the middle of next year rather than the end of next year if we carry on with these current trends. The impact of the tax cuts appears to have been, certainly for a time anyway, to have goosed up labour demand to a really quite a startling pace. And at the moment, it's very hard to see where those people could plausibly be expected to come from. I'd like to tell you that there's real evidence that labour participation is beginning to rise and that's going to come and rescue the Fed, because obviously the faster the rate of growth of the labour force, then the slower is the rate of decline of unemployment for a given pace of job growth. But I can't tell you that with any confidence at all that it's going to happen. I could have made the same argument at any point in the last 5 years, and during those 5 years, headline participation, the blue line here, has been just resolutely flat. So, you can see there are periods where it goes up and it goes down, but the trend is completely flat at the headline level. Now, the other line on that chart is prime age participation, 25 to 54-year-olds, and that's been rising. So it's got to be falling somewhere else in order to keep the headline number flat. And of course, the headline number is the one that goes into the unemployment rate calculation. So where's it going down? Well, primarily in the last couple of years, the weakness has been among young men. So the next chart, brace yourself, because it kind of looks a bit like an ECG, very noisy. What it shows is the rate of change of participation for young men and young women. It's the 12-month on 12-month change. So again, look how noisy these data are. And this is why it's such a joke for people to get excited by movements in the participation rate from one month to the next. They mean nothing. You really have to step back and look at the big picture. So the trend, it's the rate of change. So the blue line and the black line are both well below zero. That's the rate of change of participation among young men. 16 to 19 is the blue line, 20 to 24 is the black line. Participation for women is more stable and it's rising a little bit, not very much, but it certainly isn't going down. But we've seen real weakness in participation among young men. These are the people who are missing from the labour force. If you look at the other end of the age spectrum for people outside the prime ages, the 55 plus, that's pretty stable. So all the weakness that's offsetting the gain in prime age participation, all of that weakness is among younger people, and most of it is among men. Now, this really shouldn't be happening at this point. You know, we've had GDP numbers close to 4% for the last couple of quarters. We've got labour demand that's astonishingly strong. So what we've got here is the NFIB jobs hard to fill number, which is just rising relentlessly. It's at a record high now. And the other line on the chart is the rate of change, again, year-over-year percentage points in the headline participation rate. The gap is wide and widening, and I wish I could tell you I've got great confidence that it's about to narrow, but I really don't. There's no sign of it at all. So we've got a really substantial conundrum here, these missing men from the labour force, missing young men from the labour force. And the only thing I can think of that really generates an explanation that's kind of the right order of magnitude to find these missing couple of million people, unfortunately, is in the opioid crisis, which I've written about in the Monitor, but just to refresh your memory, here's the data, the number of opioid users. Now, the opioid crisis came upon the US so quickly that the federal government didn't start collecting the data in detail until 2015. So what I've done here is interpolated backwards using death rates. We do have death rates for previous years, so we can interpolate back to get the number of users. Now, these numbers probably aren't exactly right. In fact, they're definitely not exactly right, because even since 2015, when we've got the official data, the data are derived by the federal government asking people, you know, have you used illegal drugs last month? Reasonable to think that people aren't necessarily entirely honest at that point. So this, I would say, is a minimum number of opioid users, an absolute minimum. We've seen estimates well above 4 million. The point, though, is that it's a heck of a lot higher than it was, say, 10 years ago, when it was about 2 million officially. Now it's 3.3. But again, it's probably way more than that. So the speed of this thing has come about very, very quickly. Not only are there more users than there were a few years ago, but the stuff they're using is more deadly. The initial phase of opioid addiction was prescription painkillers like Oxy, and now it's fentanyl, which is much more deadly. And so these numbers are absolutely horrifying. So last year, 72,000 overdose deaths. The vast majority of those are opioids. That's a Vietnam every 10 months. It took 12 years to kill that many people in Vietnam. So this is a really horrifying story, but it's the only thing I can think of that really generates a sort of gap in the labour market, labour participation on a big enough scale to explain the weakness of participation in any sort of meaningful way. So if you kind of add back in the opioid users to the participation numbers at the headline level, it raises the participation rate by about 1.5 percentage points. Again, I would say that's an absolute minimum. It's also worth bearing in mind that the participation rate would have fallen over the last decade, actually the last 15 years. It would have fallen anyway, even without the crash, even without opioids. It would have fallen because of the aging of the population, so as the baby boomers retire. But so we don't have to explain all of that decline. Some of it was going to happen anyway. But about half of it is not explained. And opioids, I would say, explain at least half of that, and maybe 2/3 or more of that. So playing it forward, is it going to change very much? Well, sadly, probably not. The official data suggests that the number of addicts has peaked, but the US is a million miles away from solving the opioid crisis. And so I think to assume that it's going to go away and allow participation magically to rise and stop the unemployment rate falling, I mean, that strikes me as being wishful thinking of the very first order. So I think you have to expect the unemployment rate to keep declining. By the way, I should have said at the beginning, if you'd like to ask questions as I'm going through this, there's a lot of material here, and we're rattling through it pretty quickly. I'm conscious of your time. Please feel free just to send a Q&A, questions rather, through the chat, and I'll get to them at the end. If the unemployment rate really is just going to keep falling and falling quickly, what does that mean for wages and for the inflation outlook? Well, on the wage front, first of all, wage growth has picked up. I mean, it's such a myth. I keep hearing there's been no wage growth in this cycle, but there really has. The ECI bottomed out at about 1.3 year over year, and now it's 3% year over year. Admittedly, there's a gap. The rate of growth of wages ought to be about 4, and it's actually about 3. So there is a pretty substantial gap, which opened up about here, 2011. It's not getting any wider, but neither is it shrinking. And we've never seen anything like this before on a sustained basis. Obviously, there is variation in these data quite often, but such a long period with such a big gap is not something we've ever seen before. and it does require some explanation. I can promise you that if that gap were to close tomorrow, interest rates would be a lot higher than they are now. And if the gap hadn't opened up in the first place, the Fed wouldn't have gone so low, and they certainly would have started tightening earlier, and rates would be higher than they are today. It really is enormously important that we get a grip on these wage numbers so we can think about what might happen in the future. So I kind of think a good way of thinking of wages is to kind of break down the headline numbers, so currently 3%, and break it down into three components. So kind of like a bond yield, the rate of growth of wages has got a real component and an inflation compensation component. But it's also got something else, which I call a scarcity premium. And that's the idea that when labor is very scarce, people might get paid by rather more than productivity plus inflation. And when the economy is very weak, they might get paid rather less. So the scarcity premium can actually be negative. It could be kind of an abundance discount when unemployment's very high. So what's happened to these components? Productivity growth has been slow, and so the real wage element of wage growth has been compressed in this cycle relative to normal, relative to previous cyclical experience. Secondly, inflation compensation has been very low because inflation was squashed after the crash. Headline inflation was negative for a while, and core inflation was pushed down as well. And thirdly, the crash itself crushed the scarcity premium to nothing, maybe made it negative because unemployment went to 10%. So let's have a look at these, because the way you think about these components going forward is going to inform what you might think is going to happen to wage growth and hence future inflation risk, and also how the Fed thinks about these things. So I gather some of you can't hear me very well, so I'm just going to get myself a lot closer to the mic and see if that's any better. Okay. The productivity picture. So the blue line on this chart is productivity growth, and the black line is real wage growth, which, as you can see, move broadly together over time. They're not closely correlated in the very short term because the productivity data are really very, very unreliable. But the big picture here is that productivity growth peaked in the late 1990s, and it peaked at about 3.5%. This is the first sort of Tech 1.0. This is the networking of the office and the birth of e-commerce, really, really big deals. And productivity growth was very strong, and real wage growth was very strong. The subsequent cycle was the opposite story. Productivity growth slowed and real wage growth slowed. That's because housing booms are very bad for productivity growth. Borrowing money to dig holes in the ground, hoping someone else will borrow some more money and then buy it off you, that's really a very productivity destroying event. It sucks money, sucks capital out of the productive economy. So we went from a very tech innovative heavy productivity enhancing cycle to a very tech innovation light cycle with a big housing boom. Disastrous. Then we had the great crash, which also was disastrous for productivity. It spiked up during the crash itself because that's always what happens. But the trend in productivity was crushed even further by the crash because the banks almost died. Nobody wanted to borrow. Everyone was too scared. So companies just held onto their assets for longer, made things work harder, made stuff last longer. The capital stock aged, the capital stock shrank. Productivity growth was terrible. We're coming out of that now, and productivity growth has been picking up. I would hesitate to say that it's great, but it certainly is picking up. The key point I think here is that this long downward trend from about 2000 to 2015 was not one single event. It was two stories that were connected. Obviously, the housing boom was connected to the crash. But I don't really buy the idea that this is evidence of some sort of great structural change, the idea that, everything important's been invented now, the sort of Bob Gordon argument, or the Larry Summers secular stagnation argument. I'm not sure I buy that one either. I think what happened was that we had two very long periods in which very bad things were happening to productivity growth, but they're over. The housing boom is ancient history, and we're finally starting to see some meaningful recovery in capital spending. Now, the third quarter numbers weren't great, but if you just look at the big picture on the next chart, you'll see the productivity growth since 2016 has been picking up because capital spending has been picking up. We had a big capex weakening in 15 and 16, mostly in the oil sector, but non-oil was weaker as well. But things have recovered now on the capex front, and productivity growth is picking up as well. Again, Q3 capex was disappointing. You can see that dip down at the end of the chart in year-over-year terms. But most of the survey evidence is pretty positive. There's a ton of cash flow around, and most capex is funded with retained earnings rather than borrowings. So I'm still quite hopeful that actually this capex story has got some legs. One of the reasons for being hopeful is that there's an awful lot to be done. So if you look at the capital stock, this chart really is startling. What we've got here is the real capital stock. So this is buildings, equipment, intellectual property, inventory, everything in real terms, and then just look at the trend and then measure the deviation from the trend. And as you can see, after the crash, the capital stock shrank dramatically. Now, $1.5 trillion, that appears to be the current shortfall in the capital stock. That's probably an exaggeration. I don't know exactly what the number is. All this stuff is very badly measured. But it's pretty obvious that the downturn in the capital stock is way bigger than we've seen after previous cyclical downturns in the economy. Way, way bigger. So the amount of catch-up that needs to be done is really pretty enormous. And remember, as the capital stock has shrunk, it's also got older. The average piece of US business equipment now is older than at any point since 1964. That's really quite startling. So we've got an old shrunken capital stock, and we've got a ton of earnings to fund replacing it. So that really ought to give us some real strength in that capital spending cycle. If we've got strong capex, then we're going to get stronger productivity growth. So that boosts real wage growth. The textbook is right. In the US market, labor market, it's free, it's flexible. People do actually get paid for what they produce. So the second story is inflation compensation, which, looking backwards, you can see was crushed. We had that real downshift in core inflation. Never mind the headline, but core inflation collapsed as well after the crash, dropping from 2.5% to less than 1%. We had a little wobble in 2017, but fundamentally it's been steady or slightly rising for the last few years now. And so that fear of deflation has gone. Inflation is now at the target. The media has been full of talk about how inflation is at the target. And so to the extent that people need to be paid to compensate them for whatever has happened to the price level since they last got a raise, you would expect that they would be now seeing slightly bigger nominal wage increases than before. And they are. So right now, nominal wage growth is about 3%, of which 2% is inflation compensation, because inflation is 2%. And about 1% is productivity growth, because that's roughly the current trend in productivity growth. Now, my point here is that inflation compensation number probably won't change very much. I've got inflation rising a little bit over the next year, but it is going to go down. And neither is the productivity component either. Year-over-year productivity growth could even hit 2% if things go really well in the fourth quarter. I think the trend is moving up towards 1.5%, 1.75% for next year. So that alone ought to give us nominal wage growth of 3.5%, 3.75%, even with inflation compensation stable at 2%. In which case, the question is what happens to that scarcity premium? Because at 3.5% or 3.75%, the Fed probably isn't going to be very upset. And their current path of projected interest rate hikes, so moving in December and then going 3 times next year, that would be reasonable. The danger is that wage growth could rise rather further than that and put the Fed's projections at risk. And bearing in mind, of course, that markets don't even believe the Fed's projections, that's a fairly significant threat. So how do we look at the scarcity premium? Well, we know that labor is scarce. The NFIB number for jobs hard to fill is extraordinarily high, as is the NFIB's reported worker compensation number, both approaching record levels and not showing any signs of leveling off. So from an employer perspective, we know that labor is very scarce. From an employee perspective, we also know that people now think the labor market has dramatically improved. As recently as 15, 16, the number of people, or the proportion of people who think the jobs are plentiful, was kind of on that long-run average level, which is about there. Now we're very close to the record high, but more to the point, the rate of increase is going kind of all hockey stick. It's rising sort of parabolically. It would be reasonable to think that we're going to see new peaks very soon. So people believe the labor market is much, much better now. This is a really big, dramatic change. People think that if they were to lose their job, they could get another one pretty quickly. And of course, the chance of losing your job at random is really quite low now, because jobless claims, here's the entire history back to 1948, jobless claims as a share of payrolls are the lowest they've ever been. So the chance of randomly getting fired on any given day is lower than it's ever been. And if you do get fired, then you probably think your chance of getting another job is really pretty good. So however you kind of measure this now, it looks to me like the labor market is in a really quite a different place to where it's been for the last few years. What that ought to mean is that scarcity premium, which currently is about 0, because wage growth right now is just equal to productivity plus inflation, that scarcity premium could emerge pretty quickly. So here is the Phillips curve for the US. Unemployment on the bottom on the X and average hourly earnings on the Y-axis. I've ignored the period from 1970 to 84. That was kind of the inflationary era after Vietnam and then the oil shocks. So just looking at the period before that and the period after that, we get quite a nice Phillips curve chart. You can see third quarter 18, the current quarter, is below the curve, partly because, of course, productivity growth has been weaker. But if productivity growth was normal, about 2% rather than 1%, we would be about here now. So we'd still be below the curve. This is the potential scarcity premium over the course of the next year if productivity growth picks up in the way that I think. Now, I think this is entirely realistic because this is what's happened before. But remember, a year from now, unemployment is going to be at about 3.2, which would put us, well, off the chart, literally. That would suggest if we were extrapolating that curve, we might end up, up here somewhere. Now, I'm not suggesting that average hourly earnings growth is going to get to 7%. What I am suggesting is that if you think it's going to be 3% forever, the risk that's facing your view is almost exclusively to the upside. How much of the upside? I don't know. We've got a very small sample of what happens when unemployment gets to these very low levels. Remember, these data go back to 1955. And there's no unemployment rates of 3% in that whole sample period. So we're really at the point now where the scarcity premium could become a very, very big deal. Now, at the moment, the Fed's view of all this is, well, not so much worried about it. So here's what Rich Clarida, the new vice chair, said about this very point just a few weeks ago. A sustained rise in inflation-adjusted or real wages at or above the pace of productivity growth, and that is a scarcity premium. Real wage growth above productivity growth, that is a scarcity premium. That's typical in an economy operating in the vicinity of full employment. And we're starting to see some evidence of this. Well, not very much evidence, but nonetheless, I certainly hope it continues. Well, I kind of hope it continues as well, up to a point. And what Vice Chair Clarida did not say is the point at which he hopes it would stop. So we have a clear view from the Fed that some excess real wage growth, some scarcity premium would be welcome, but no indication of how much would be welcome. Of course, what we do know is, of course, that whenever wage growth has got above 4%, the Fed's been tightening like crazy. The highest rate of wage growth that we've seen since 1990, so 27 years, is 4.5%. At that point, the Fed was above 6%. Again, I'm not suggesting we're going there, but it's a question of the balance of risks relative to where we are now and relative to where the markets think we're going. Because if this scarcity premium comes in quickly, and again, just to make the point, look at the hockey stick nature of the chart as unemployment gets to be very low. This really is the big threat. So what I'm expecting to happen is that over the course of the next 6 to 9 months, wage growth picks up clearly and unambiguously. The spike that we saw in the October hourly earnings number was a base effect, so that won't be repeated every month. But I do think that the run rate will accelerate to the point where the year-over-year gets to 3.5 by next spring, and we'll see some 4 handle potentially by the end of next year. And I think that means that the Fed has to do at least as much as they say they have to do. Partly because if wage growth does that, we're going to see much faster increases in rents, which are 41% of the core CPI and nearly 20% of the core PCE. So it makes a material difference. So the rent numbers at the moment look relatively unthreatening. They kind of flattened off over the last year and a half. Partly because the vacancy rate flattened off. But here's the thing, the model, as you can see, has rent inflation picking up quite sharply over the course of the next year. The vacancy rate is extremely low. Oops, gone too far there. Let's go back. The vacancy rate is extremely low. It did tip up a little bit in the third quarter, but these data are very noisy, as you can see. The trend is essentially flat, but I think it's going to go down. I think it's going to hit new lows. I think it's going to go below the lows of the late 80s. Clear new lows are coming. Why? Well, because the house buying market is weakening. So this is total home sales, which, as you can see, have rolled over. This latest point here, this latest drop, that's the hurricanes. Don't worry about that. But the trend, the trend clearly, we've gone up and now we're softening, and that's because mortgage rates have risen and lending standards have tightened. So remember, at the same time, we've got very strong payroll growth. So where are all these people going to live? They're all getting new jobs at quite a very rapid rate, in fact, but they've got to live somewhere. So it seems to me that rental demand is going to go up. Now, The problem with rental demand rising quickly is that it can't be met quickly by a shift in supply. So what we're going to face over the next year or so is essentially flat multifamily supply. So permits lead completions by more than a year, and permits leveled off a long time ago. So we've had a really big uplift in multifamily completions, but it's done now. So what we'll see over the next year or so is rising demand against a period essentially of flat supply. And that means that the vacancy rate is going to keep falling. Now, the other thing that's in my rent model, again, just to go back to the output of the model, the other thing that's in the model is wage growth. So again, this is why the scarcity premium was so important. And also productivity growth, because landlords don't care whether people are getting a raise because their productivity has gone up or because the scarcity premium has gone up. They just see them getting a raise and say, well, thanks very much, we'll have some of that. So I think there's quite substantial risk to go from 3.25 to 4.25 in wage growth adds 0.4 to the core CPI by itself. It adds 0.2 to the core PCE, and the danger is it embeds itself into expectations. So there is, of course, some other stuff that's going on, and there's just a few things that are worth just looking at. First of all, the stronger dollar is holding down goods prices. It's not a perfect indicator of goods prices, but it really is hugely important for things like clothing and furniture and electronics. So, over the course of the next year, I would expect inflation in goods prices to go down, actually to start falling again. But remember, the unit labor cost story, the wage story, is mostly about services, and services are roughly 3/4 of the core index. But the goods components are things that people notice. They're probably going to go down. I don't see much risk there. The drop in oil prices over the last few weeks is not a big deal in the short term, because it typically takes about 6 quarters for a movement in oil prices to come through into the core CPI. So this here is the latest drop in oil prices. So that's not going to come through into the core CPI until late next year. So it's not going to make a big difference in the short term. It is going to pull the headline rate down. I think we'll probably see a cumulative hit of about 0.5 on the headline CPI from the drop in gas prices. But I think at this point, with the labour market so tight, the Fed is not going to believe that that's going to have any sort of favourable second round effect on wages. The labour market is just too tight for that. And then there's the final wild card thing to think about is kind of deep breath territory. It's tariffs. So the current position is that the 10% tariffs apply to 200 billion of Chinese imports in September. The order that was issued from the White House to impose this says that on January 1, that tariff rate goes up to 25%. Now, that's not contingent on anything. It just says rising to 25% in January. It also says that if China retaliates in any way at all, then the US could impose tariffs on the remaining $267 billion of Chinese imports, presumably at the 25% rate. Those imports are mostly consumer goods. The 200 billion is mostly not consumer goods. You can download the whole list from the USTR website. You need to have some time to spare when you do that, because it's 194 pages. But if you do that and look through it, you'll see that most of the things on there are not consumer goods. The remaining 267 billion is almost entirely consumer goods. Now, if that would happen, well, there's a few things that would happen in response. Presumably the RMB would weaken significantly, and there would be some margin compression along supply chains. There would be some movement of production out of China into non-tariffed countries. But that can't all happen overnight, especially the movement of production for bigger, more high-tech items. T-shirts, yes, but electronic components, not so easy to move a factory overnight. Same with furniture as well, of which China is now a huge supplier to the US. So I think you'd have to expect to see a fairly significant pass-through into the core CPI. Roughly 10% of the index is very, very China sensitive. So that's clothing, electronics, and furniture, plus some smaller bits. About 10%. Now, 25% tariff, now what would that do to the price level of those 10% of the index? I don't know, might raise it by 10%, allowing for a lot of margin compression. Well, that's 1% on the core CPI all by itself. This is why I think it isn't going to happen, because the consequences are so huge. I think the Fed would have to raise rates in that environment, because the lesson of the 1970s, which is seared into the brain of every central banker today, is that if you get a price level shock, like the oil shock in the 70s, and the labour market is in a position to absorb it and convert it into faster wage increases, then what you have to do is deal with the inflation shock and not worry or not try and deal with the growth shock. So in the 70s, the UK and the US tried to pretend that the rise in oil prices hadn't made them poorer and kept policy too easy. Wages went nuts, inflation became embedded, took 20 years to get rid of it. The Bundesbank took the opposite approach, and 2 or 3 years later, they were back to where they started, and they spent the next 20 years getting richer, while the UK and the US struggled mightily. That experience is very much the formative experience of central bankers. And I think that the chance that the Fed would just stand back and say, it's just a price level shock, it'll disappear from the data in 1 year, let's not worry about it, I think that's very low. Their model will tell them that with a 3.5% unemployment rate, that price level shock would translate into second round inflation really quite dramatically. And I think they have to hike. They'd be hiking into slower growth because, of course, a 25% tariff on 267 billion is a significant tax increase. But I think they'd have to do it. I'm kind of hoping this message is getting from the Fed to the administration. I don't know, but I hope it is. And if it does, I think it makes that imposition of the crazy tariffs rather less likely. And we have a little bit of an example of what happens when you apply tariffs to consumer goods, because the one thing in the CPI where we do have significant tariffs is laundry equipment, washing machines, which was aimed at LG and Samsung in particular. But this is what happened to the CPI laundry equipment component after the tariff was applied. It went nuts. It all was passed in. I realize that there's not many alternative supplies for washing machines. It's not like moving T-shirt production from China to Bangladesh overnight. The impact on other consumer goods wouldn't be as big. But nonetheless, this is a really very big deal, and it came through very, very quickly. US producers who are competing with imports which have been tariffed will raise their prices. It's not just about the price of imports, it's about the price of the domestically produced goods which compete with them. So that's kind of my worst nightmare scenario. Like I said, I don't think it'll happen because I think it's politically insane. There's also a bill in the Senate which I expect to be revived over the next few months, which Bob Corker introduced. Now, he's retiring, but nonetheless, Republican introduced the bill to remove the president's authority to impose tariffs under Section 232 of the Trade Expansion Act. That's a national security thing. The bill didn't go anywhere in the summer because of the midterms, but it's got support from quite a lot of Republicans as well as Democrats. Keep an eye on it. It might actually happen, and that would be great because that would take the tariff threat away completely. As it is, like I said, I don't think it will happen. I think there will be some face-saving compromise that prevents us falling down this rabbit hole. It's hurting the US, it's hurting China. Look at the PMIs. Neither of them are pretty from both countries, and it's becoming very self-defeating. Anyway, I've mentioned it because it's a wild card risk to the inflation environment. So let me kind of just wrap up, and then happy to take any questions. So in the near term, what have we got here? Very limited inflation risk, I think, very limited, because the unit labor cost story is fine. The dollar is strong. It's very difficult to see a sudden spike in inflation, current inflation, unless we get the tariff craziness. But that's not the point. The Fed is focused on the labor market because they believe it tells them something about future inflation risk. And because monetary policy operates with very long lags, and again, the usual benchmark 12 to 18 months, with policy operating with those sort of very long lags, then we're looking at a Fed that has to be thinking about the future impact of today's policy. In today's policy, remember, real rates are 0. Unemployment 3.7%. We've never had a combination that looks anything like this before. Real rates of 0 have never slowed down the US economy, and they're not going to start doing it now. Corporate debt service ratios are still falling 3 years after the first rate hike. 3 years. After the first rate hikes in 2004, it took 2 years, exactly 2 years, for corporate debt service ratios to start falling and start to exert some restraint on growth. It's taking longer now because everybody did what the Fed wanted them to do during QE, which was take longer debt. So bank debt's much longer than it used to be. Corporate debt is much longer than it used to be. So rollover risk is taking much longer to crystallize, and that means the debt service ratios are still falling. So right now, 3 years after the first rate hikes, the Fed is not exerting any real restraint on the economy. The danger is that, if the labor market goes crazy, the wage numbers go crazy over the next year, they'll have to exert rather more restraint than they think. And that really essentially boils down to these questions of what happens to productivity growth and what happens to the scarcity premium. Productivity growth, of course, shouldn't scare a central bank. If real wages accelerate in line with productivity growth, no big deal. Everyone should be happy. But I've got to say, I've never seen anyone in the market stop after a big hourly earnings print and say, well, that doesn't matter because it's productivity growth. It doesn't work like that. there comes a point in the cycle where the nominal numbers become alarming, and we're not there yet. But that's the best time to be thinking about what you do when we get there, because when we get there might not be very far away. And when we get there, if unemployment at that point is 3.25% or 3% and still falling, and the real Fed funds rate by then is up to 50, 75, even 100 bips, I think I would expect that the Fed would then keep going, because there will come a point where the fear of future inflation risk is forcing them unambiguously to say and to act in a way that slows the economy down. So we stop talking about removing accommodation and we start talking about the pressure on resource utilization rates, which means unemployment is too low. And when we get to that point, the Fed will positively want to slow things down. It will no longer be a question of just saying, let's try and freeze everything where it is, because isn't it great? That won't happen. And bear in mind, of course, that next year they're dealing with yet more fiscal stimulus. The fiscal stimulus doesn't really become negative until late next year. And so the difficulties that they face, I think, could become quite acute in a fairly short space of time. Again, remember that lesson from the hockey stick of the Phillips curve. It can become quite steep and move really quite quickly. So again, the sea is calm. The inflation environment at the moment is fine. The sky is blue. But as we all know, big storms can blow in very quickly. I think it would be very difficult to say that we couldn't see them coming. This is not the 15th century where the weather forecasters, ask somebody 100 miles to the west of you and that's tomorrow's weather. We do have some things that tell us what's going on here, and everything that I'm looking at in the labor market tells me that we're kind of on the verge of this meaningful shift from a post-crash frightened labor force with abundant labor and low productivity to a labor force which is more emboldened. The number of strikes is going up, for example, against employers who are frantically trying to find the people that they want, and sooner or later that's going to manifest itself in some data which becomes much more disconcerting to the Fed. Anyway, I think I have talked enough at this point. So if anyone's got any questions, then I think you should be able to ask them by chat. So I will shut up for a minute and wait and see if anyone has any questions. So yeah, so here we go. Right. So just to go back in order of the questions that have come in already, but to go back to the thing about opioids. Someone asked, does it include prescription drugs? Yes, it does. That's all opioids. The vast majority of them, the numbers that I showed you there, are synthetic opioids, but it doesn't distinguish between those which are prescription, like actual fentanyl, and homemade or imported fake fentanyl. It's all in there. Does it affect men more than others? It seems to, yes, but death rates have been rising across all age groups and both genders. Question, if the consumer keeps spending fueled by wages and real income, what will the impact on CPI be? Can the economy quickly adjust output due to technology? Is inflation structurally capped as a result of technological advances? Well, the key impact of stronger growth in most inflation models, very strong growth in the late stage of the cycle, is that your model would tell you that profit margins will widen. So the biggest component of inflation is labor costs, but on top of that, you've got to look at the dollar and commodity prices and margins, and you would expect margins to expand at that late stage in the cycle. Now, can the economy adjust thanks to technology? Well, yes and no. I mean, the CPI is a fixed rate basket, so it doesn't adjust super quickly, and a lot of the stuff that's in it is not really susceptible to technology at all. 41% of the core CPI is rent. And that's not really technologically affected by anything much at all. The core goods component, well, I mean, technology generates incremental improvements in productivity all the time and has done, ever since the first machines were invented. It's not at all clear that we've reached any sort of turning point where those improvements are quicker. In the services sector, it might be a bit different. Technology is making a difference. It's allowing restaurants to run with fewer staff. We've all ordered at McDonald's through machines now. And iPads and all the rest of it, and yeah, that is an incremental improvement. After a very long period in which productivity in the restaurant service sector was kind of zero. So yes, at the margin, some of these things are meaningful, but are they game changers? Against a super tight labor market and potentially widening profit margins? Well, probably not. And that's the question about wages on unit labor costs. That's just a one-for-one. Unit labor cost is just the rate of growth of wages less the rate of growth of productivity. So if productivity growth doesn't pick up, I think it will, but if it doesn't, and wage growth next year, is about 4 rather than about 3, then yes, unit labor costs rise by 1%, and most inflation models would then give you 70 to 80 bips on core inflation. When looking at unemployment, should we be more concerned with U5 and U6? Well, you need to look at all of them to get a broad view of the labor market, but I think the Fed's focus has been very much on the headline rate. Janet Yellen always used to say that there's loads of unemployment indicators. None of them are perfect, but the headline rate is the most useful. Not least because it's the one that helps to inform people's expectations. The front page of USA Today is never going to talk about U6. It's going to give you the headline unemployment rate. And so I think that how should I put this? A disproportionate influence from U3, the headline rate, is likely to continue. And then, so I've read that when outputs are capacity and unemployment's below NAIRU, go risk off. Can you comment on this? Well, unemployment's been below most people's estimates for NAIRU for a very long time, and yet wage growth hasn't gone mad. And during this period, being risk off would have been a mistake. What I think I would sort of define it more closely and say that when the labor scarcity premium emerges, that's the time to go risk off, because that is the point at which the Fed panics. So that hasn't happened. What's happened is we've gone below the NAIRU, and wage growth has picked up, but it hasn't picked up very much because the only reason for the pickup is a little bit of inflation compensation rising and a little bit of stronger productivity growth, zero scarcity premium. And so that's allowed us to be below NAIRU without triggering a change in the market environment. What changes if the scarcity premium suddenly gaps higher is that the Fed's attitude will change as well. And like I said, they'll stop talking about just no need to be accommodative anymore. They'll come out one day next spring or next summer and they'll say, we now need to be unambiguously moving towards tightening because we've got pressures on resource utilization rates which raise the risk of future inflation. That's the way that they will describe it. So it's not simply a question of being below the NAIRU in and of itself. It's the consequence, I think, is what counts. And that consequence to me is going to be a sharp rise in the scarcity premium at some point before not very long. Is the data either ECI, unemployment rate, average hourly earnings you believe will scare the Fed, leading to more aggressive hikes? Well, most of these wage numbers move together over time. The ECI hourly earnings, the Atlanta Fed's median number, the total compensation numbers in the productivity report, they all tend to trend roughly together. There's a lot of short-term variation. The Fed looks most closely at hourly earnings in the short term because it's monthly, and most of these other numbers are quarterly or come out with a lag in the case of the Atlanta Fed. So average hourly earnings is the shorthand, I guess. So that's the one that is potentially the most scary to the Fed if it does accelerate. If it accelerates at the same time that the unemployment rate is falling further, then you've got two reasons to be scared. So yes, I do think that when if we're going to get a change in the Fed's approach, if we're going to get them standing up and saying, hey, we just can't let this go on any further, a combination of faster wage growth and lower unemployment is the most likely to do it. But either one of them by themselves could do it as well if the movement is big enough. That's for sure. What's yet more fiscal stimulus next year? Well, I'm just taking the CBO's estimates here of the impact of the bills that were passed in December and March, which show a discretionary rise in the deficit this year and next year, and then essentially nothing in 2020. So it's the lagged effect of the corporate tax cuts primarily. On the consumer side, I think we've had it now actually. So if you look at the retail sales report that came out today, was very instructive. Core retail sales growth in the 3 months to October compared to the previous 3 months was about 2.5%. So that's ex autos, gasoline, food, the core retail stuff. It's about 2.5% annualized. In the 3 months to July, it was over 9% annualized. So we saw a massive spike up in spending in the spring and the early summer, and we've now gone back to where we were before. So as far as the consumer is concerned, it's pretty much done. So it's more on the spending side, non-defense and defense, which was agreed in March. And it's also the lagged effect working through on the corporate tax cuts. That's where the fiscal stimulus comes from. It's not on the consumer. And I think there's really no chance of fiscal 2.0 tax cuts 2.0. That seems very unlikely to me. Possible infrastructure bill? I think not. Mitch McConnell said today that Republicans aren't interested in a big stimulus bill, so that's pretty unambiguous. But even if they were interested in it in principle, I don't think it would happen in practice because the Democrats want the fiscal stimulus, want infrastructure to be funded primarily by public borrowing, whereas the Democrats want it to be. The Republicans want it to be financed by private sector, private finance. Democrats want it to be publicly financed, and the gap between them, I think, is unbridgeable. The Democrats look at the private finance initiative in the UK, which was formally abandoned by the Chancellor in the budget a couple of weeks ago, as a great series of reasons not to do privately financed infrastructure, because the public sector gets ripped off. It costs way more. The user costs are much higher. The financing cost is much higher, and you lose control of these public sector assets. It's just been a total disaster in the UK. The Democrats have learned this lesson. Republicans appear to be oblivious, and I think the gap between them is unbridgeable, unfortunately. Finally, one more question. Where does PC end up with the unemployment rate at 3.4 and even further 3%? Well, that depends on what happens to the scarcity premium. As I said, if you draw that chart and take it down to 3%, then you could end up with wage growth at 7%. So deep breath and think what that means for core PCE. It means an awful lot. But I don't think we're going to go there, because I think the Fed ultimately will squeeze the labour market to prevent us having unemployment at 3% for any length of time. We might be there for a while, but I don't think we'll be there for very long. And so the pressure that would engender on the labour scarcity premium, I think, would be fairly brief. But ultimately, if they don't constrain it, if they fail to tighten enough and unemployment gets to 3% and the trajectory is still downwards, then I would worry that we would end up with core inflation peaking at this cycle above 3%. They definitely do not want that. Clearly there is some tolerance for core inflation to be a little bit above 2%, and I have a lot of sympathy with that, having spent so long below the target. But to get it to 2.5%, 2.75%, 3%, that's a place they really don't want to go, because they would be very worried about it becoming embedded into further wage growth and starting off some sort of wage price spiral. Nothing like the numbers that we saw in the 70s, but just the principle is something that they don't want. Again, the uncertainty here is enormous. I can't stress enough how big the uncertainty is, because the scarcity premium is such a difficult thing to pin down. It does seem to be quite highly tied up with the psychology of the labour market, in particular the willingness of individuals to push for bigger raises. And we just haven't seen that in this cycle, because people have been scared for a very long time. The crash was a monumental psychic shock. Everybody knows someone who lost their house or lost their job or both. Everyone's 401ks got created. For a very, very long time, all people wanted was to have a job, any job, and they weren't bothered about getting raises or getting grumpy and banging on the boss's door demanding more money. I think we're on the verge of that changing, but how quickly, how far it goes, I don't know. What I think is very unlikely is that it goes back the other way. And that wage growth spontaneously slows down. Finally, one more question. I've taken a lot of your time. So what level of the Fed funds rate will put us in a recession? Well, not the 3% that an awful lot of people seem to think is going to be enough. I just can't see that would raise corporate debt service ratios in a meaningful way. And US recessions are typically triggered by corporate debt service ratios rising. So businesses cut back on inventory, they cut back on capex, they cut back on people. That's the starting point of the recession. But to do that, you've got to get those debt service ratios up, and it just isn't happening, and it won't happen very much with funds at 3%. So, if you want to tell me that they're going to eventually need to get the funds rate at 4%, I'm not going to argue. Entirely possible. My point is that we're into territory that we've never really been in before in this sort of post-crash environment. And I think you've got to keep an open mind about how things might work out. Debt service ratios are a lot lower than they used to be, but maybe business confidence is more fragile because of the shock. There's a lot more debt than there used to be, but the maturity of the debt is a lot longer. So how this all plays out, bearing in mind that no cycle has ever looked anything like this, is really very difficult. What I think I am happy to say is that the risk to market expectations is to the upside, and the risk to the Fed's expectations is also to the upside. Bearing in mind that the market isn't yet up to where the Fed thinks it's going, that means that markets potentially have really quite a big adjustment. And ultimately, that adjustment, it will be the trigger for the downturn, hopefully, because it will tighten financial conditions more broadly. The dollar will rise. We'll see a substantial widening of corporate spreads. We'll probably see a substantially weaker equity market in the spring or the summer of next year. And a broad tightening of conditions. Confidence will decline, and we'll end up with, I think, a mild recession in 2020. It's very hard to see why there would be a severe recession, because right now the US corporate sector is saving more than it's investing, and the US personal sector is saving more than it's investing. There's never been a deep recession with that sort of starting point. All the imbalances in the domestic economy is in the federal government because of the tax cuts and the spending bill. That's the counterpart to the current account deficit in big picture terms. So if you don't have domestic imbalances in the private sector, for a developed economy, it's quite hard to have a nasty recession. Different for EM, because in an EM, markets can force recessions on you overnight through the government, just by effectively not buying the debt. That doesn't really happen in developed economies unless you're very small or you're stuck in the Eurozone like Portugal or Ireland or Greece. Then you can have that forced upon you by the markets. But the US is not in that position. The recession will be a private sector phenomenon. It won't be very bad, but after 11 years of expansion, which is what it'll be by then, it'll be very unpleasant. And I think it does require an adjustment in markets and an adjustment to asset prices, which after all, valuations are still quite high, and the profit share in GDP is hugely elevated. And if wage growth is going to go to 4.5%, that profit share in GDP is going to come barreling downwards. Sooner or later, it's going to come really barreling downwards. And if that's happening at the time when interest rates are at their peak for the cycle, then you're looking at a valuation hit and an earnings hit. Not yet. Wouldn't surprise me at all if the equity market was to see new highs before the cyclical downshift actually begins. But the cyclical downshift, I think, is coming, and I think it'll be worse than the real economy slowdown, because we're starting from such a point of elevated profits, which ultimately can't persist if the labour market really is rebalancing and the power is swinging back towards the employees after 10 years when all the power has been with the employers. Anyway, I think at that point we are out of questions, and I'm pretty much out of voice. So I'd like to thank everybody for participating. Thank you. Many of you have stayed on to the very end, so thanks very much for that. Anything you haven't got around to asking, please feel free to stick in an email or send me a Bloomberg, and I'll happily deal with it later. But for now, that's all from me, and thanks very much for attending. Thanks.